Today we're going to talk about how to determine whether to continue holding a position or whether to sell it and take your profit. This is a question I often get, and I usually get it in response to an earnings position that I recommended and paid off. In particular, we're going to be looking at some earnings trades and answering the question for those trades. And I'm going to do this mainly because there's no real general answer to whether to continue holding or to sell a position that has already paid off. This actually is determined by many factors, including your initial investment thesis, including your targets. So I can't give you a general answer to this question, but I can give you some tips and some methods that will help you determine this question's answer for your particular trade. So I usually get this question after an earnings trade, like HSBC. So I recently recommended to short HSBC before earnings, and as you can tell, that prediction was correct. Now, if you don't know what an earnings trade is, essentially what you do is you go to nasdaq.com/earnings/report and then whatever ticker you want. So here we have Goldman Sachs. And what happens is you'll get a page, and the important thing on that page mainly is the date. It'll also tell you the expected EPS. And what we're looking for in many cases is whether the real reported EPS is going to beat or not meet this predicted EPS. But for now, let's not care about how to make an earnings prediction. Let's just talk about if an earnings prediction is correct, what do you do afterward? So here we see on April 18th, Goldman Sachs is set to report earnings, and we would make a prediction on that stock. I haven't looked into this in depth, but at the moment I'm looking at a short position. So the idea would be to open a short position, either actually outright shorting the stock, which I never do, or by opening a synthetic short, which is the same as buying a long put option and selling a call option, or just buying long call options. The idea would be to hold on to that position until April, I believe it was 18, and then on April 18 we'll see something that usually looks like this in one direction or the other. So we have a big gap, and then at that point you're asking yourself, do I sell on this day and take the profit, or do I continue holding on in hope that the stock falls further? That's the question we're trying to answer here. Now, the answer to that question has to do with many factors, but one of the most important ones is whether you're holding stock or options. So what I'm going to do here is I'm going to close some of these charts. What do we have here? We got stochastics, volume. I'm just going to open another chart and make it bigger. So one chart I'm going to be looking at here is options indicators, call and contract volume. Call and put contract volume. So down here what we got, I'm just going to make it really big. Down here what we got is the contract volume for put and call options. Now put options are short positions, call options are long positions. And what we're doing is we're looking at what's happening. Are people buying calls? Are people buying puts? And this determines a few things. Most importantly for our earnings trades, a rising combination of calls and puts, or whatever you're holding. So let's say you're holding the put and you're seeing that the put contracts are going up. That means there's more demand for puts, which doesn't necessarily mean the puts are going to be more expensive, but it does mean one important thing, and that is, here we are, and that is the bid-ask spread right here. We want a smaller bid-ask spread because we're able to sell at a more reasonable price. So that helps. If we see that the call options or whatever option you're holding on to is going up in volume, it means it's a better time to sell because you can get a tighter spread. That's issue one. Now, I generally don't put too much emphasis on this issue. I put a lot more on a different issue if you're holding on to options, and that is the volatility. Here we go. Under option indicators, and you can find this elsewhere, you don't have to use what I'm using. but you can find statistical volatility and implied volatility, and you need to look at both. So I'm going to go ahead and make these smaller so you can see this again. Alright, so what we're looking at here is a yellow line that represents statistical volatility and a green line that represents implied volatility. The statistical volatility is the real volatility of the stock. It measures how volatile the stock is. In other words, it's showing you how likely the stock is to move quickly in either direction. The implied volatility is the volatility priced into the options. So it doesn't actually match reality. It's just what the options are telling us the volatility is expected to be. Now, interestingly, for HSBC, the implied volatility didn't change, but the statistical volatility changed a lot. To determine whether an option is going to be expensive or cheap relative to reality, what you do is you look for crosses in these two lines. So you see here where the yellow line crossed below the green line. What that means is that the options are overpriced from this point onward, because the volatility that's priced into the options is more than the real volatility. So at that time, you generally want to sell options and don't buy them. Now, when the real volatility jumps, you want to buy options and not sell them. So at this point, it's a good time to buy them. Now, here's what happens on earnings, and this is something you're going to see in pretty much every earnings report. The volatility spikes, and then it immediately drops afterward. So you've got a very short time frame when options, well, this is actually a bad example, because what you're going to see is you're also going to see the implied volatility spike. Here's the point I'm getting at. Let me think of another Facebook report recently. It's not showing up. Goldman Sachs didn't, I don't think so. What else? What did we play recently? Alexan. Alright, so when implied volatility spikes, just think of it this way. When implied volatility spikes, the green line spikes, the option contracts improve in their price. The price goes up. And you want to sell when they're higher, right? So after earnings, when you see this drop right here, it means the options are becoming worth less money. And if you're selling as you wait, what happens is the longer you wait, the cheaper the options become. So even if the stock trends in the direction you want it to trend, it might not do so fast enough to compensate for the loss in value due to volatility. And if that's the case, you're going to find yourself maybe being correct in the direction of the stock movement, but incorrect in that determination as to when to sell your options. So I generally say sell the options right after earnings if you're playing an earnings trade. Now, what if you're not playing options? So I'll give you an example for HSBC. I sold on the day of earnings. I took that profit, and obviously if I had held on, I would have gotten maybe $100 more per option. But the volatility here, we don't see it dropping a lot. So in this case, I was wrong by selling it a little early. But in most cases, that volatility drops pretty quickly. And even if you make $100 because you're being correct in the direction, you're being wrong in the direction of the volatility, and you might lose more than $100 by holding on to that option for too long. Now let's assume that you're playing a Vega neutral strategy, which means you're either holding stock or or you have an option strategy that doesn't rely on volatility. If you look at options, by the way, and you add Vega into your charts, you'll see numbers for Vega. These numbers tell you how the option changes for every 1% increase in implied volatility. Remember, this green line is implied volatility. If it drops from, let's say, 20 to 18, then you multiply Vega by 2, and that's how much you can expect for the options to drop in value. So that's something you can calculate, and if you can make estimates of how volatility will change in the future, you can estimate how much the options will fall in value after earnings, regardless of direction. All right, so let's say you've played with options and you've got a Vega neutral strategy, or you're using stock, which is inherently Vega neutral. Should you hold on after earnings or not? And I think this is a question that most people want answered. Now the question is very specific depending on your, it specifically depends on your earnings, on your type of trade and your thesis. So if I'm just trading on earnings, my bet is that it's going to fall on earnings, and then whether I hold on is based on the individual stock's characteristics after earnings. Now, if you don't have the ability to backtest this and look at how the stock reacts after earnings, you can eyeball it. You can go back to each earnings and see which way it moved. There's 4 things that can possibly happen. But I'm gonna just tell you the 4 possibilities. So the first is, we're talking about post earnings, right? Or whatever event that happens. So let's say you're correct in the event. Maybe you're looking at a merger or something, and you're correct, the merger did not go through, so the stock fell and you had a short position. Now your question is, do you continue holding or do you sell? Whatever that event is, you're going to see there's certain characteristics in individual stocks. And you can backtest it with data, or you can eyeball it. But, so, I mean, we can look at a quick pattern for GS. But there are 4 possibilities. The first is, we'll talk about the most important one last. So the first is upward trending. Second is downward trending. The third, we'll just say drifting. And the fourth is mean reversion. So 1 and 2 should be pretty obvious. Some stocks just, regardless of whatever event happens, always tend to drift upward or always tend to drift downward. A stock like Facebook, I believe, is an upward drifter. So no matter what happens, if you're holding on to a short position, for example, let's say this was Facebook and it sold off on earnings, you'd want to get out of that position quickly because Facebook has a tendency to drift upward no matter what happens. But there are 2 other types, and they are drifting, which means it moves in the same direction it just moved to a big degree. So HSBC might be a drifter, where after it sells off, it goes downward, or after it rallies, it continues going upward. And then there's what, in my experience, happens to most stocks, which is mean reversion, where it does the opposite of what just happened. So if it just sold off, the stock will start to move back upward. And if you've taken my gap trading course, you'll recognize this as area gap filling or gap fading, which is you have a gap and then eventually the stock fills that gap by moving up to the point of when that gap occurred. Now you have to make the determinations on your own, either through backtesting or from looking at patterns. So you might see that for GS, we consistently have this upward movement followed by a quick pullback, upward movement, quick pullback, upward movement, quick pullback. And if you see that you're in that current state, you can ask yourself, what's going to happen next? Are we in that quick pullback? If so, it's most likely that GS is going to pull back if it rallies real quickly. Now, if we don't see that, if we see, for example, a sell-off, what happens after the sell-off? Does it continue selling off, or does it move upward? And GS looks pretty cyclical. Like this trend, we see huge upshifts followed by well, this was 2008. That's a exception. But we'll see these huge upshifts followed by pullbacks, and the pullback can be extended or short. The downward pattern isn't so clear to me, but you can use statistics or whatever programming you have to look for these patterns. An easy way to do it, if you have the time, is just to look at how it moved after 5 days after earnings for the past 5 years. So that would be 20 total data points you'll need. So you'd have 20. Why? Because, well, you got 4 quarters per year, and you want to look at the 5 years prior. So that's going to give you 20 data points. And all you'd do is you'd see, okay, so after earnings, the day after earnings, after it reported earnings, we're looking at after earnings is incorporated into the price of the stock. Maybe HSBC fell to $20. Now you look 5 days afterward, or 7 days afterward, or 10 days afterward. You look a week or so afterward, and you see it moved from $20 to $19. Then the next one, you move one quarter back, and you saw, it was at 21, and then it moved to 20, and then you'll see maybe a quarter before that it was at 20, and it moved to 21. You go through these, and you take these 4 hypotheses, and you see whether they apply. So upward trending would be, does it always move up? No, no, yes. So what we have is 1 out of 3 data points that supports that hypothesis. Then we'd look at downward trending, yes, yes, no. Then you look at drifting. So if this earnings report was a sell-off, and this one was a sell-off, and this one was, a rally, we'll see, sold, and then it moved in the direction of the sell-off, so that's 1. So that's a 1 yes. Sold off, moved in the direction of the sell-off, rallied, and then it moved in the direction of the rally. In this case, we'd have more data that points to it being a drifter. So, of course, you're not going to base this on 3 data points. You're going to go back and look at least 20 data points, and you might see that for these categories, you might just want to write them up, down, drift, and then revert, and then count the data points out of 20, and you might see something like 1, 16, and then another 16, and then like 4, something like that. They'd have to add to 40 or 20, right? So you might see that, it looks like, I don't think they've ever come out to be equal in my experience, so it'll probably be something like that. So what you'll see is we have more evidence pointing to this stock being a drifter, which can answer our question at the very beginning that we asked, what do we do after an event? Do we sell or do we continue to hold? If we know that the stock is a drifter, then that answers our question. It's going to continue moving in that direction. So in this case, you would hold. If it's not clear to you what you do, well, just think of it logically. If you believe that it's going to move in a direction and you are right, then drifting is good for you, and you want to keep holding onto that stock to gain more of that profit. Remember, this is under the assumption that you have a low Vega value for your position or you're Vega neutral for that position. So this is generally what I do. This is how I make my plan. On earnings, so on this date, I went and I looked at HSBC and I made the determination that it's probably not a drifter. In this case, I was wrong. But that was my characteristic determination of HSBC. I forget what it was, but sometimes I don't get enough data points. Sometimes I don't get enough evidence in a certain direction. So I might have just sloppy evidence, or it might just be like 10-10, and you don't want to deal with that. You don't want to deal with 11 or 12-8 either, because that's not a big of a difference. In statistics, we call it a statistically significant difference, and if that's not going to be, if that's just going to be due to random fluctuations, then you don't want to place money on that. We're not gambling here. We're trying to be in line with probability and limit our risk so that we're going to be right most of the time, and because of that, that's how we make money trading. We don't gamble. So if we know that, for example, Goldman Sachs drifts like this, most of the time it drifts, then that's a good bet to hold on to, because most of the time you're going to be right. And if you keep playing earnings on Goldman Sachs and you're in line with the statistics, you're going to make money on holding afterward rather than selling. So I hope this answers your question. And yeah, I haven't made a video for a while. I'm going to be making more videos, but I have had some issues with my environment. It's just not quite enough to make videos most of the time. So I'm moving shortly, and when I do, I will have a better place to record videos, and you can expect more content from me. In the meantime, please subscribe, and once those videos do come out, you will get a notification for them. I don't care if you like the video. Likes do nothing for me, but do subscribe and leave a comment if this was useful. You can also leave requests for other videos or just your general questions, and if it's a good enough question that can help enough people, I will make a video for it. That's all for now. And peace.